What makes the world's billionaires billionaires? Certainly not because of their 9-to-5 job. It's about having multiple passive income streams. Let's take a look at Microsoft, for example. In addition to creating 3 billionaires, Microsoft has also created more than 1,000 millionaires, making it one of the largest IT businesses in the world. As a result of technological advancements like the web and globalization, there are currently more people in the world who are millionaires than ever before. Because the world changes so quickly, if you aren't smart enough, you could lose your riches in a blink of an eye. That's why an average billionaire has 7 sources of income. What if something goes wrong? You don't want to risk losing everything. Welcome back, everyone. This is Capital Finance. Today, we will take a quick look at practical passive income ideas that millionaires use today. Before we start, make sure to hit that like button. First is ordinary income. This is the most common sort of revenue. It covers wages, salaries, incentives, and benefits. When you're exchanging your time for money, you're in this situation. Even though you'll always be constrained by time, earning money in this manner has other drawbacks. It was estimated that the United States government collected $3.3 trillion in taxes in 2018. And of that, 51% was derived from personal income taxes. Only 8% of the government's revenue comes from corporate income tax. As a result, most taxes are paid by persons on income. Additionally, payroll taxes account for a further 35% of the government's revenue. However, studies have shown that businesses pass on their share of the expense to their employees. So, 86% of all taxes are paid by people with earned income, while billionaires pay virtually nothing. It's the easiest way to get money because you don't have to put much thought into it or take any risks, but it's also the most taxed because anyone with the right abilities can get a job. However, it is not a long-term solution since if you lose your job, you will lose your only source of income. Second is rental property income. Rental income is a popular choice for most people. You buy a house, then rent it out. You don't have to be actively engaged to enjoy it in most cases. However, I've found that it takes far more time than most people expect. Some tenants stay for a few months, and some stay for several years. Some people care for your property, while others don't. Some pay on time and don't cause you any trouble, while others are just a nuisance, so the system has both positives and negatives. However, renting out commercial property to other businesses is also an option of renting out a commercial property, which may be a better option in some situations. Everything from your automobile to your cell phone can theoretically be rented out. Real estate, on the other hand, is the most common. Third is income from interest. It's one of the most straightforward methods of earning money. It's more of a passive income, meaning you don't have to put in an effort to get it yourself. Because of this, the rate of return is often lower than that of other types of investments. It occurs when you issue bonds to a government agency, a bank, or a business to secure a loan. The bank usually takes your money and lends it to someone else at a higher interest rate. Afterward, it returns your half of the deal and retains the remainder. Basically, that's how the banks make their money. It's common for the government to raise funds via selling bonds. When you purchase a bond, you effectively lend money to the government. Fourth is income from a business. As the name implies, profit is the money you make as a result of doing so, either through the sale of a product or the provision of a service. Among these income streams, this is the most significant because while other sources of income offer returns of 5, 10, or even 15%, this can only be accomplished if you already have a substantial net worth. In contrast, a business that starts with just $100 can yield a 1,000% return, thanks to the wonders of the internet. When you have a lot of different ways to make money, even if one isn't doing so well, you still have a lot of options open to you. It's a full-time job just to keep track of one revenue stream. Imagine what happens when you have several. In other words, don't go from one job to the next based slowly on pay. First, focus all of your energy on mastering just one of them. And then, after you've earned enough money to support yourself plus another source of income, move on. This is how individuals become wealthy in the first place if you look at it that way. Fifth is income from dividends. Since failed investments can be carried forward for the remainder of one's life, investors continually sell them and reinvest the proceeds back into a similar asset to realize their losses. As a result, when you make a capital gain, you either significantly reduce your tax burden or pay no taxes at all. However, there are many more ways to make money from stock purchases, including dividends. Even if you only own a tiny fraction of a firm, holding stock is like owning a small piece of it. And it's understandable given the fact that today's corporations are worth trillions of dollars. In addition, as a shareholder, the corporation must distribute its profits to you in the form of a dividend. However, even if a firm makes billions of dollars, such as Google, Boeing, or Meta, the earnings are frequently reinvested back into the company. That's why most investors care more about the stock's value than its dividend and less about the company's profitability. However, certain corporations such as Apple pay dividends to shareholders. This quarter, Apple shareholders will receive a dividend yield of 0.56%. It's not much, but it's better than nothing at all. Sixth is income from royalties. In 1997, Jeff Bezos applied for a patent for an internet ordering system. Clicking buy is an easier alternative to adding an item to your shopping bag. There's no way anyone could have thought of patenting something so obvious, but Amazon has made billions by licensing this patent to firms like Apple for the previous 2 decades. Companies today file for many patents even if they don't need them because they see them as a possible source of revenue. Real passive income can be found in this type of investment. Writing a book or filming a movie are examples of work you continue to be compensated for even after completion. This is also a common source of income for artists, such as musicians, allowing others to use or resell their work. Seventh is income from capital gains. When you purchase a stock or a piece of real estate to resell it later on for a profit, it is considered a capital gain. Capital gains come from that profit margin you've made. For example, let's say you acquire 100 shares of stock at $100 each for $10,000, and the stock price rises to $120. So, you'll walk away with a profit of $2,000. Capital gains on long-term investments are taxed at a rate of 15% to 20%. Whereas short-term gains are taxed at 37%. Because the tax rate is just 20%, it's a popular choice for millionaires. But if you're clever, you can avoid paying any tax. The first method is quite simple. Even if you make billions of dollars, you don't have to pay a penny in taxes if you don't sell your investment. You may have to sell some of your investment to get extra income, though that isn't always an option. The second option exists because of this. Take advantage of tax losses. When you make a loss on the sale of an investment to lower your taxable income, why would you deliberately lose money at first glance? Let me give you an example of what I'm talking about. Assume you're a seasoned investor with a diverse array of companies under your belt. Great job on a $300,000 gain in your stock A. The bad news is that the value of your stock B has dropped by $250,000, making your investment worth only a quarter of what it was before. Let's assume you'd like $50,000 in cash by selling $50,000 worth of stock A. To put this in context, a capital gains tax of 15% is the ideal rate, or $7,500. It's possible to avoid the loss entirely by selling your stock B for $150,000. and then purchasing an identical investment for the same amount of $150,000. You can write off $50,000 in realized losses from your taxable income. So if you sell $50,000 worth of stock A, you can write off the $50,000 loss. Voila! Your taxable income has been halved. Which of these effective passive income ideas would you like to learn more about? Tell me in the comment section below. I'd be thrilled to know. So, that's the end of our video. If you like this topic, be sure to subscribe to Capital Finance and click the notification bell to get notified on our latest uploads. See you soon!